September 15th, 2008.
Lehman Brothers suffering a spectacular downfall.
Fear came back into the market in a very big way.
Lehman Brothers is going bankrupt, largest in U.S. history.
What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
People are seeing this, and those memories of fear are coming back.
A bank that had survived the Civil War, the World War, and the Great Depression filed for bankruptcy, gone in a single morning. Lehman Brothers, 158 years old, 639 billion in asset, wiped out after a weekend of failed rescue talks. Berkeley walked away, Bank of America walked away, and on Monday morning, the doors didn't open. In the weeks that followed, retirement accounts shrank overnight, millions lost jobs. Family who had never missed a mortgage suddenly owned more than their homes were worth. Around 19 trillions in household wealth disappeared. But Lehman's wasn't the cause, it was what happens when everything else already broke. And that's where it really begins. Why rent when you can own? In 2002, America is recovering from the dot-com crash and shaken by 9/11. The Federal Reserve cuts interest rate by near zero. The idea is simple. Cheap money boosts borrowing. Borrowing boosts spending, and spending restarts the economy. It works, but it also makes mortgages extremely cheap. And when mortgages are very cheap, everyone wants a house. In America, home ownership isn't just practical, it's identity. Status, the American dream.
The American dream. The American dream is alive and well.
Banks notices this, and lending standards start to slide. First carefully, then aggressively, and then completely out of control. The assumption was simple. House price always go up. Not even if someone defaults, you just sell the house. There was only one problem. House prices don't always go up. They just hadn't gone down yet. Then came the extreme version, ninja loans. No income, no jobs, no assets. If you could sign your name, you could get a mortgage. Mortgage brokers earn commissions on volume, so volume matters more than risk. In 2005, buying a house wasn't just about living in it anymore. It was just about flipping it. Fast appreciation, fast profits. And if everyone believes price will rise, prices rises. This is what bubbles looks like when you're inside them. Banks didn't keep these mortgages, they sold them. Wall Street bundles thousands together into mortgages-backed security, MBS. On paper, this made risk safer. Spread across many borrowers, a few defaults wouldn't matter. But when the underlying loans are all weak, bundling doesn't reduce risk. It actually hides it. Then came the rating agencies. Moody's, S&P, Fitch. They were paid by the same banks creating the product they were rating. So risky mortgages bundle, subprime, low documentation, unstable income received AAA ratings. The same rating as US government bond. If you think about it, it's actually quite crazy. But it gets worse here. Those bundles were packaged again into something even more complex, CDOs, collateralized debt obligations. Layers of risk, stacked on risk, all stamped AAA and sold globally to investors who couldn't see what was inside. A few investors did look. They saw the defaults rising, they wanted to bet against it. There was no simple way to do that. So they asked Wall Street to create one. Wall Street agreed. The instruments was called credit default swaps. Insurance on assets you didn't even own. No real limit on exposure. The system was now betting against itself. It starts actually slowly. Missed payments, foreclosures, empty homes in cities, then 2007 hits. Subprime loans collapse at scales. Mortgages-backed securities lose value. Banks realized that they are holding far more risk than their rating suggested. Panic spreads. Hedge funds collapsed. Investment banks report massive losses. Bear Stearns is rescued in March 2008. Then September arrives. Lehman Brothers spends a weekend trying to survive. Berkeley walks away. Bank of America walks away. The government decide not to intervene. On September 15, 2008, Lehman Brothers filed for bankruptcy, 639 billion in assets, the largest bankruptcy in US history. And suddenly, every bank realized the same thing: if Lehman can fail, anyone can. By late 2008, unemployment nears 10%, markets lose over half their value, and the crisis spreads globally. The Great Recession begins. The government has a choice: let the system collapse or save the institution that caused it. They choose rescue. TARP or TARP, 700 billions to stabilize banks and buy toxic assets. AIG received 182 billions after writing 440 billions in credit default swaps without reserves. GM and Chrysler receive emergency support to prevent industrial collapse. The Federal Reserve launched quantitative easing, pricing liquidity through bond purchases and near zero interest rates. Markets eventually stabilized. Wall Street recovered quickly. Main Street does not. Final damage: 8 million jobs lost, 4 million houses foreclosed, and 9 trillion in wealth wiped out. Most executives kept their job. Some received bonuses their following year. Accountability was minimal. Only one major conviction came from the entire crisis: that fact didn't just anger people, it changes how they saw the system. I want to tell you where I was when this happened. In 2008, I was working as an engineer in Brazil. Brazil didn't collapse the way the US did. Strong reserve, conservative banking. Watching from there changed how I understood system like this. It wasn't that people didn't understand the risk. They did. The problem was incentives. And when incentives are wrong, even smart people make catastrophic decisions. Years later, their realization is part of why I ended up in blockchain and decentralized ecosystems. Then there is something I still think about. January 3rd, 2009. 4th month after Lehman collapse, someone mined the first Bitcoin block. Inside, it was a message from the time: canceller or brick of second bailout for banks. That wasn't random, it was a response. Bitcoin wasn't created in theory, it was created from failure. Whatever you believe it or not, 2008 matters. Because the condition that caused it, cheap money, misaligned incentives, hidden risk, don't disappear. They move, they just move. They come back in a new form. The next crisis won't look like the last one. It will look normal until it breaks. If this helps you understand what actually happened, subscribe. I cover the financial story that shaped this generation. And if you want to understand how this connects to crypto and what came after 2008, that's the next video. See you next week. Bye.